Is Tips Music the ultimate cash machine, or just riding a temporary wave? Today, we are breaking down the financial analysis of Tips Music for the full year and fourth quarter of fiscal year 2026, examining a massive 106% EBITDA surge and its zero-debt empire. In this breakdown, we will unpack four core areas. First, the fourth quarter blockbuster numbers. Second, the revenue and margin surge. Third, the cash flow engine and balance sheet, which boasts zero debt and massive free cash flow. And finally, their unique clean slate accounting edge to see why their policies matter before weighing the bull versus bear case using a definitive red flag checklist.
Looking at the fourth quarter records, the full year of fiscal year 2026 completely crushed guidance with 21.3% revenue growth compared to the 20% expected. Quarterly revenue reached 103.93 crore, marking a 32.4% year-over-year increase and crossing the 100 crore quarterly milestone. Operating EBITDA scaled up massively by 106.1% year-over-year to 76.90 crore, while profit after tax jumped 92.9% to 59.06 crore, translating into an earnings per share of 4 rupees and 62 paise for the quarter. This brings us to the operating leverage effect, where top-line operations benefit from broad-based digital monetization across streams and short-form video. Operating EBIT surged 93.4% year-over-year to 80.10 crore, driven by a high-margin evergreen catalog revenue that acts as a baseline profit engine. This operational profit is completely unrestricted, as finance costs sit at a negligible 0.04 crore, representing essentially zero drag on the business.
This efficiency has unlocked unprecedented margin expansion, with the operating EBITDA margin climbing 2,650 basis points year-over-year to land at 74%. The core growth driver here was a 55% year-over-year reduction in expensed content costs for the quarter, falling from 29.9 crore in the fourth quarter of fiscal year 2025 down to 13.6 crore in the fourth quarter of fiscal year 2026. While margins contracted 500 basis points quarter over quarter, this simply reflects normal structural volatility based on exact release schedules. The secret behind these high-quality earnings is their phase-based clean slate accounting engine. In Phase 1, during the release quarter, 100% of content acquisition costs are expensed instantly, absorbing the hit up front and creating short-term structural fluctuations in EBITDA margins. Then in Phase 2 and all future quarters, there are zero unamortized content risks carried onto the balance sheet, resulting in 100% clean earnings with no future exceptional write-offs.
This accounting strategy supports an impenetrable balance sheet showing zero total debt, leaving the company completely insulated from interest rate hikes. Their liquid war chest holds 267 crore in deployable capital safely parked in mutual funds, cash, and receivables. Their current ratio stands at an extremely strong 3.12 times, reflecting short-term liquidity backed by 302 crore in assets against 97 crore in liabilities, while trade receivables scale healthily at 34.34 crore, moving perfectly in line with top-line revenue growth. When evaluating earnings quality, accounting profit after tax for the full fiscal year stands at 216.75 crore, while operational cash flow reached 197 crore. This represents a phenomenal 91% conversion rate of accounting profits, translating directly into hard operational cash. Because the business has a minimal capital expenditure requirement of just 26.39 crore, it generated a massive 190.61 crore in free cash flow. With such high free cash flow generation and minimal capex needs, the capital strategy allows the direct pass-through of internal cash accruals straight to investors, passing the cash to shareholders through high dividend payments. The total payout reached 166.18 crore, distributed to shareholders, which amounts to a cumulative 13 rupees per share in fiscal year 2026. Looking at the digital moat and key performance indicators, the company commands a massive audience of 153.1 million YouTube subscribers, compounding its organic reach and ad revenue. They released 66 new songs in the fourth quarter, maintaining a strict focus on content quality over raw volume. Their revenue mix is 70% digital, capitalizing heavily on paid audio streams, meaning that even though fourth quarter YouTube views dipped to 48.5 billion due to shorts format shifts, core monetization remains completely untouched.
This shapes a compelling asset-light cash factory bull case, driven by three main factors. First, pricing power tailwinds as Indian streaming shifts to premium paid tiers, where platform price hikes equal direct royalty bumps for tipsmusic. Second, ownership of an evergreen library containing over 34,000 tracks provides a recurring, zero-cost, high-margin revenue base. Third, a premium valuation context is highly justified, as a zero-debt status, massive cash funnel, and 16 rupee and 96 paise annual earnings per share allow for frictionless margin scaling. However, the bear case highlights key risks to monitor, starting with content acquisition wars, where bidding for major film music rights remains fiercely competitive, meaning expensive quarters can severely pressure operating margins. There is also platform concentration risk due to a heavy reliance on a few global tech giants like YouTube, Meta, and Spotify for direct audience consumption. Lastly, algorithm dependency means structural shifts in platform algorithms or commercial terms, like the recent shorts format shift, can introduce top-line volatility.
To double-check the financial health of the business, we run it through a red flag screener. Is there a widening gap between profit after tax and cash flow? No, there is a highly efficient 91% conversion rate. Are there heavy one-off earnings? No, growth is driven purely by operational core licensing. Are receivables building up out of control? No, they are scaling proportionally to top-line growth. Is there aggressive or unseen capex? No, this is an asset-light model with less than 7 crore in annual capex. Our final verdict is that tipsmusic represents a highly lucrative, debt-free content factory positioned perfectly to ride massive digital monetization tailwinds. Does tipsmusic deserve a premium valuation, or are future content acquisition costs too risky? Let me know your thesis in the comments below. And if you found this tipsmusic earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.